The next move up will probably everyone will expect it to hit 3,000 and stop. My guess is it'll go through 3,000 and continue.
Continue where?
Wow. Now you're getting into some serious stuff here, but it's always hard to say. But I for this year coming into this year, I said 3,000 was where we were headed. I
Yeah.
would generally raise that target by year end, probably to about 3,300. I still think it's going to have a lot more upside in the coming years as the debt fiasco doesn't get under control. So I would be looking at 4 or 5,000 within a couple years. But I think again, let's keep it conservative this year. Let's raise it from 3,000 target to 3,300 on gold this year.
Gold prices have rebounded after reaching a one-week low in the previous session, driven by ongoing market uncertainty and geopolitical concerns. The instability surrounding former U.S. President Donald Trump's tariff plans has bolstered demand for the yellow metal, a traditional safe haven asset. However, analysts caution that Trump's proposed tariff hikes have raised inflationary concerns at the Federal Reserve, which could lead to prolonged higher interest rates. This in turn might limit gold's upside potential, as rising interest rates reduce the appeal of non-yielding assets like gold. Despite short-term resistance levels, Gareth Soloway, chief market strategist and president of Verified Investing, maintains a bullish outlook on gold. He notes that while gold is on track to reach $3,000 per ounce, psychological and technical barriers may lead to temporary pullbacks before prices ultimately break through. Historically, market movements often fall short of widely anticipated price targets before experiencing a brief decline and resuming their upward trajectory. Weaker U.S. economic data, including a sharp decline in consumer confidence, have also fueled gold's recent gains. According to the conference board, U.S. consumer confidence fell to 98.3 in February, the lowest level since August 2021, marking the most significant drop in sentiment in over 2 years. Concerns over slowing economic growth have further supported gold's safe haven appeal. Despite near-term consolidation, gold remains bullish, with prices above the key 100-day exponential moving average on the daily chart. Soloway has revised his year-end target for gold to $3,300, with long-term projections ranging between $4,000 and $5,000 in the coming years. The persistent concerns over fiscal policy, inflation, and economic instability underpin gold's strength. On Friday, the focus will shift to the U.S. Personal Consumption Expenditures (PCE) price index for January, a critical measure of inflation that could influence the Fed's monetary policy stance. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
For the short term, yes. I mean, if you're talking the next couple of weeks, it probably is. I still think gold is going to $3,000 an ounce. But I think you mentioned something very, very poignant early on in our discussion, which is that maybe everyone was expecting it to hit 3,000 and ready to sell there. So instead, it's stopping just a little shy. Markets behave like that. When there's a big wall of sellers and everyone's anticipating it, oftentimes that will create a top before it gets there, and you'll get a pullback. And then once people start throwing in the towel and saying, oh, gold is over, right? I still remember in 2022 or so, 2023, everyone was saying, oh, gold is over. No one wants gold. It's all about Bitcoin. And then what happens? Gold goes on an epic run. So I think you're kind of using that psychology here in the right way. And in the short term, we know that gold sells off when there's panic in the markets. We're starting to see a little bit of that. Remember in COVID, gold sold off as well in March of 2020. And so it rebounded very quickly. And I think that'll be what happens here. But in the near term, it likely is going to pull back. I have my downside target. You can see very clearly, this was your high pivot right here. We chopped around, we broke out. So in general, you would expect charts to bring it back to that level and then make your next move up. And the next move up will probably, everyone will expect it to hit 3,000 and stop. My guess is it'll go through 3,000 and continue.
Continue where?
Wow. Now you're getting into some serious stuff here, but it's always hard to say. But I for this year coming into this year, I said 3,000 was where we were headed. I would generally raise that target by year end, probably to about 3,300. I still think it's going to have a lot more upside in the coming years as the debt fiasco doesn't get under control. So I would be looking at 4 or 5,000 within a couple years. But I think again, let's keep it conservative this year. Let's raise it from 3,000 target to 3,300 on gold this year. And there's a couple things to look at in the chart. So number one, you have to go back to the previous bull market. So if we go back on the weekly chart and we look at the last bull run, which really started back in 2003 or so, we can see that gold actually went a lot further. Now, granted, it took about 10 years, but it had a 500% move up in that period. So that would imply that we could easily do more than just 50% in one single year, especially over the next few years. All right. And if we go back even further, we can see here in the 1970s, during a very similar time of inflation, we went up 700%. So you can see the percentages as price goes up in gold go down a little bit, but this still implies, let's say 300, 400% of upside this bull run. And I think that's very logical to think about over the next year, next couple years. The other thing to keep in mind is that I'm just not a believer that the U.S. is going to get their debt situation under control. I think that as soon as we start to see the economy stuttering and the stock market coming down, Trump, which gauges his presidency on how the stock market is doing, is going to start telling the team at Doge to stop doing what they're doing and stop cutting jobs and stop doing this type of thing to get the economy back on track. And then ultimately, I think that, again, a safe haven asset like gold, if the economy kind of stalls out, and you think about how much money is in stocks still right now, there's a certain amount of that money will come out and look for a safe haven. The bond market might be a recipient, but also gold will be a recipient of a lot of that money coming out of stocks. And I think that's another reason. I think part of it is the fact that people are much more aware of the U.S. deficit and the debt. It's become much more mainstream in a lot of the media, and it's worrying a lot more people. So a lot more people than maybe 10 years ago are saying, wait a minute, what's going on here? I need to diversify away. And I think that also gave rise to why crypto became so popular as well, specifically Bitcoin. So I think all of those factors are involved. I also think it's important to recognize that if you go back to the all-time high previously on gold and adjust it for inflation,
U.S. Treasury Secretary Scott Bessent has expressed concerns that the U.S. economy is more fragile than surface-level economic metrics suggest. In his first primary economic policy address since taking office, Bessent emphasized the need to reprivatize growth by reducing government spending and regulation. He pointed to factors such as interest rate volatility, persistent inflation, and an over-reliance on public sector job growth as key challenges weighing on economic stability. Despite these concerns, official data continues to show resilience in the economy. U.S. GDP grew at a 2.8% rate in 2024, slightly lower than the 2.9% recorded in 2023, defying expectations following 2 years of Federal Reserve rate hikes. Fed Chair Jerome Powell recently described the economy as strong overall, supported by a still low unemployment rate of 4.0%. While job growth has slowed, the current labor market conditions suggest the Fed may extend its pause on further rate hikes for the time being. At the same time, recent economic indicators highlight emerging risks to consumer sentiment and spending behavior. Market strategist Gareth Soloway notes that consumer spending, a fundamental driver of the U.S. economy, shows signs of weakness. The decline in consumer confidence, combined with weaker than expected retail earnings from companies like Walmart, suggests that lower and middle-tier consumers may be cutting back on discretionary spending. This trend could signal broader economic challenges ahead, particularly as inflationary pressures and policy uncertainty persist. Let's get back to the interview.
In the markets, right? So when you have a cycle date, you expect a major trend change. That date was December 16th, right over here. And you can see that while we have popped around here and chopped, we've barely been able to go up, and you can see the market starting to come down. So the cycle is the change in kind of the atmosphere of the markets. And you can see from that point, we've really gone sideways. And another great chart to show this is on the NASDAQ 100. Here was exactly December 16th, the cycle date. And if you look, we came up, we did a double top, and you can see the NASDAQ has now broken major uptrend support right here, this low going back to the August lows, and now we are headed lower. And listen, there will be bounces. Buy the dippers aren't going to vanish, but ultimately this should be the bigger change in the markets, where instead of chopping sideways now, which we've done for a couple months, it should start being, sell the rip type rallies. We've seen recently the Michigan sentiment numbers coming in much weaker than expected. Consumer sentiment numbers coming in weaker than expected. We have Walmart earnings, which I think were a major turning point in the market, because Walmart, everyone was trading down to Walmart, but you didn't have a lot of people going below Walmart. And we saw people spending lots at Walmart until this latest guidance that they just gave about a week ago, where we saw Walmart breaking to the downside. In fact, let's go take a look at that chart. And what we can see is Walmart was up here at these crazy levels, valuation 40 forward PE, which again, Walmart should never be trading at. They just gave a slightly weaker guide, which tells you the consumer is slowing. And before you know it, we saw a big drop. We're getting a bounce today, but this is not over if the consumer consumer is stopping. And you know this as well as I do, David. The consumer is the backbone of the U.S. economy. And if that player is slowing, and even the mid-tier to upper tier is slowing, this economy is in some trouble.
Is Walmart indicative of the broader stock market right now, or do you think that the tech stocks are a better indicator?
Yeah, so I think Walmart has been an indicator of institutional money, meaning that, you don't find a lot of smaller investors that are so excited to go in Walmart because they're going to make double or triple their money. That would be more reserved for a Palantir, PLTR here. And what we can see on Palantir is that it has now dropped from 125 back to about $85 in a matter of 5 trading days. Other names to watch, take a look at APP, another cult following here. Look at this beautiful parallel channel, by the way. It goes right up there on earnings, gets rejected, and comes in hard, negating that entire move. And then you have other names like OKLO, huge moves to the upside in the short term, but retracing these type of moves. And lastly, I'll mention Hims and Hers. This one again collapsing to the downside after these meteoric runs. So you have two kind of tones to the market. The institutional side, which has been going into the names like Walmart. They're the types of players that are in some of these bigger high flyers like Amazon and the big caps. And then you have the smaller kind of Robinhood investors. Speaking of which, take a look at Robinhood's collapse lately, and these now are getting punished. So it's both sides of the spectrum, and that tells you that money is now exiting the market. It's not necessarily rotating like what we saw over the last couple months.
Gold continues to be a favored option for those seeking protection from market fluctuations. While shifts in monetary policy and inflation may shape its future, grasping consumer behavior and spending patterns is essential for maintaining economic stability. It's fascinating to watch how inflation, interest rates, and geopolitical factors influence market trends. We're eager to see how resourceful investors adjust their strategies to secure and grow their wealth in this ever-evolving landscape. Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.